In Unit 9, we cover chapters 22 and 23, and we also begin working on our second case analysis, Case Study 2. In Unit 9, we'll cover Chapter 22, Managing Assets, Chapter 23, Managing Risk, and beginning the case analysis on Pearson's Air Conditioning and Service. This is Text Case 22. You can find these in your textbook. Okay, students, we're into Unit 9 now. We're going to be covering Chapter 22 and Chapter 23 in Unit 9. So let's get into Chapter 22. Very interesting chapter here on managing the firm's assets. So let's see what all this is what all is involved here in doing that. Some definitions for you to be aware of here. First of all, working capital management. What is that? Well, it's kind of self-defined, right? It's the management of current assets and current liabilities. Typically, when we talk about working capital, that's what we're talking about, current assets and current liabilities. So the net working capital is the sum of a firm's current assets. Well, what are current assets? It's cash, accounts receivable, and inventories, less current liabilities. Well, what is current liabilities? Short-term notes, accounts payable, and accruals. And the working capital cycle, then, is the daily flow of resources through a firm's working capital accounts. So basically what we're talking about here is the flow of money or the flow of resources through accounts receivable, current assets and current liabilities. That's what we're going to be talking about now for a little bit. So here's a summary of the working capital cycle, and we'll see a little bit more detail here in just a moment that we'll work through. So step number 1, we purchase or we produce inventory for sale, and that increases our accounts payable when we do that. Step number 2, we sell inventory for cash, or we sell inventory for credit. When we sell inventory for credit, that's going to impact our accounts receivable. Step number 3, we pay the accounts payable. That's the stuff that we've charged. That decreases our cash and our accounts payable. Step number 4, we collect the accounts receivable, which decreases the accounts payable and increases cash when we do that. There's an error in number 4. That should be decreases accounts receivable, not decreases accounts payable. So let's go through it again. Step number 4, right here. We collect the accounts receivable, which causes the accounts receivable to decrease when we do that, and it increases our cash. Then, step number 5, we start it all over again. So this is the regular cycle that goes on in any business. We're managing our current assets and current liabilities, or our working capital. So let's look at it in a little bit more detail. So step number 1, we purchase or we produce inventory. That increases our accounts payable. Here's just where we are right here on this chart. I've got a bad deal going right here on this chart. And then we increase our inventory. So we increase an asset, we increase a liability. We sell the inventory. That means we decrease the inventory. Not necessarily have we collected anything yet, but we've kind of taken the first step toward it. So we've sold the inventory. Now if we collect cash for that inventory, that cash goes immediately to the cash bucket down here. If we sell it for credit, that increases our accounts receivable. We don't have any cash yet, and this really initiates a whole another set of steps to manage this activity right here, which we'll talk about later on in the course. We go to step 3, where we have to pay now our salaries and our operating expenses and taxes, and we have to pay our accounts payable, which that decreases the accounts payable account, and it also decreases cash in both cases. So step 3A, paying the accounts payable decreases cash. Step 3B, paying our operating expenses, salaries and taxes, decreases cash. So you can see now, everything here is kind of focusing toward this cash bucket down here. Everything becomes really important to our cash supply. And we're going to find out as we go through this course that cash supply is really, really important to a company's operation. If you're going to operate a company, you've got to focus on cash and what's happening with your cash. Step number 4, we collect our accounts receivable. When we collect our accounts receivable, our customers are paying us, and we're putting that money into our cash bucket. So all of these things that we do in the working capital cycle then ends up focusing down here on this cash bucket. Then step number 5, we begin that cycle again. Now, let's look a little bit at the working capital timeline. This is an important concept to understand, so we're going to spend a little bit of time talking about it.
So basically what we were talking about just a moment ago can be expressed in a timeline. We order some inventory. We place the order. The inventory is received here at Node B. The inventory is ultimately paid for. That's the days in inventory. Is ultimately sold. That's the days in inventory. And then we ultimately pay for that inventory. That's point number D. And then at some point in time, if we sold that inventory on credit, we collect the money for that inventory that we sold. That means cash collections of receivables. That's point E. The days in accounts payable is the time period from when we receive inventory that we've ordered till the time that we pay for that inventory right here, point D. That's days in accounts receivable. The cash conversion period is the period of time it takes to convert this paying of accounts payable into cash that we get for the sale of the item, which is the payment of accounts receivable. So here we pay, here we collect. At point D we pay, point E we collect. So that's the cycle that we need to really understand. Now if I look at that timeline just for a little bit, and I say from a practical standpoint, what would I like to have happen here? Well, from a practical standpoint, I would like for this cash conversion period to be 0 or negative, right? And to make that happen then, I've got to make this point right here line up with that point right there or go beyond that point, one or the other. So what I'm really trying to do here in this whole timeline is I want to make the cash conversion period be as small as possible or even negative. Well, let's look at a couple examples here. Pokey and Quick Turn. Pokey, as you might guess, is kind of slow doing everything. Quick Turn is on top of managing their accounts payable and accounts receivable. So to accomplish what we were talking about in the previous chart, we've got to really manage carefully our accounts payable and our accounts receivable. Those are our two big capital accounts. All right, so in Pokey, I order something on August the 15th. It's delivered 2 weeks later on August the 31st. It stays in inventory for, how long is that? 45 days, August 31st, September 30th, October 15th, 45 days roughly. And then we sell that inventory, and now it goes into accounts receivable, and it stays in accounts receivable for another 45 days. Now this is not a bad deal right here, this 45 days in inventory. Necessarily, you'd like to keep that down as small as possible. You want the days in inventory to be very, very small. And in fact, this is the whole concept behind just-in-time manufacturing. I want that inventory to be, the days in inventory to be small. Then I want my days in accounts receivable to be small. Let's see what in Pokey's case, it's 45 days. So Pokey's letting his customers go 45 days without paying. And so that says Pokey's got to really manage that better, this cash collection of receivables. Now let's look on the accounts payable side. He's paying his accounts payable right on time. He's paying his bills right on time. He's got an agreement with his suppliers to pay them in 30 days. So his cash conversion period now is the difference between the payment of the inventory and the collection for the sale of the inventory. That's the cash conversion period. In this case right here, cash conversion period is how long? 60 days. Too long to convert all of that effort into cash. Now let's look at Quick Turn. Quick Turn places his order, gets his inventory in just like Pokey. It stays in inventory for 30 days, so he gets that inventory turned pretty fast. It's not 45 for him, it's 30. It stays in accounts receivable for 30 days. He manages his accounts receivable. Now look right down here. He's worked out an agreement with his suppliers, or maybe he's stretching them a little bit, to not pay them in 30 days, but to pay them within 60 days. Now, how realistic is that? Some cases it might work, some cases it might. You're getting into a kind of a gray area there. Most of your suppliers are going to get a little edgy about that. But what you couldn't say is, look, we're going to stretch it out beyond 30 days, and we'll get an agreement from our suppliers that says, hey, we might go 2 weeks beyond the 30-day period, or we're going to get a little bit of grace period from you there, or we'll do some other things that we have to do. But anyway, we're going to try to make this collection of our money line up with the days in accounts payable. So we collect our money, we pay our bills on the same day. So our cash conversion period in this case is 0. Remember, we said that's our objective. We want that cash conversion period to be 0. Let's look at the Pokey's balance sheet just for a little bit. Here's their balance sheet when they started in July. They had $400 of cash on hand, had fixed assets of $600. I won't say 400. We'll just say dollars. We'll just say 600. It could be 600,000 or 600 million, whatever. And so now their total assets are 1,000. And if we look down here, they've got long-term debt of 300, common debt, which is short-term debt, of 700. And so they've got assets and liabilities balancing out. Now let's go move forward to September. This is their balance sheet again. You can see here what's happened. In August, Pokey bought $500 or 500 something of inventory, and they still have that inventory on hand in September, but they paid for that inventory in September. So they've got the inventory, they paid for the inventory, and so now they've depleted all their cash, and the cash that started at 400 is now a negative 100. Nothing's happened on the fixed asset side. Nothing's happened on the accounts payable side except they pay their bill. And so now they're sitting around waiting to collect that money that they paid. Let's fast forward to October. So you see that Pokey still got that cash problem in their cash account. Now they've got an accounts receivable of 900 whatever. 900 says that they shipped that inventory finally in October. And so now what's going to happen? They've got an increase of accounts receivable of 900. They've got an inventory decrease because they shipped it of minus 500. And oh, by the way, they've went through a quarter, and so they've accumulated some more depreciation here because they went through they're accumulating appreciation every quarter. And down here on the liability side, they've got an additional accrued operating expense. They had to pay some salaries and whatnot of $250. They had some income taxes to pay. They went through a quarter of 25, and they've got some retained earnings of 75. Okay, so that says that somewhere along the line they made some profit of about 100. They retained 75 of their earnings. They paid income tax of 25 on it. Now, what happened in Pokey's balance sheet? They increased their accounts receivable by 900 because they made some sales. This is the impact on the income statement. So I made some sales of 900. I increased my accounts receivable by 900, all credit sales. I decreased my inventories by 500. My cost of goods sold go up by 500 because I shipped that in the sale, the 500 inventory. I increased my accrued operating expenses by 250. My operating expenses go up by 250 on the income side. I increased my accumulated depreciation by 50. My depreciation expense goes up. I increased my accrued taxes by 25. My tax expense goes up. So here's the corresponding impacts on the income statement due to what we see taking place on the balance sheet. Now let's go to November. In November, we collect our money. We collect the $900 of accounts receivable. And by the way, from a practical standpoint, you almost never collect 100% of your accounts receivable, so you have to allow for that in your pricing and in your profit planning. So here we have a plus 550 in cash because we collected 900, and we accumulated some depreciation right here of 50, and we paid some expenses here of 250, and we have an income tax payable of 25 and retained earnings of 75, and everything balances out here on this balance sheet. Now let's look at Pokey's income statement. This was in November. Now we're going to learn a little bit later that an income statement covers a period of time, a balance sheet covers an instant in time. So we'll talk more about that. Had sales revenue of 900, pardon me, cost of goods sold of 500, a gross profit of 400, and here's their operating expenses. So the total operating expenses were 300. Their operating income was 100. Remember we talked about that? Income tax of 25. Net income of 75. So that's kind of what happened at Pokey. Now, let's talk a little bit about the nature of cash flows and managing our cash flows. The nature of cash flows is the flow of actual cash through a firm, and that determines whether or not the firm can meet its current obligations. So cash flow is really important to what we're trying to do, and that's why during the capital management exercise, that the working capital management exercise that we talked about earlier, we talked about a lot about cash, and what we were really talking about is net cash flow. Now, net profit is the difference between revenues and expenses, and the growth trap It's what happens when we're growing faster than our cash and our supply of revenues can handle the growth. All growth has to be paid for. It has to be financed. And so if I'm going to grow my company, I've got to be generating enough cash to pay for that growth, or I've got to generate enough cash plus debt or whatever my other resources are to pay for that growth. If I can't do that, then I've got the growth trap. The classic example of the problem here is when a small company starts growing faster than it can pay for it, and though growing rapidly and just apparently beating the world at its business, it goes bankrupt because it runs out of cash to fund the growth. That's called the growth trap. And many small companies face that. So here's the flow of cash through a business. We have the original investment from the owners. We have borrowed money. That's our debt. We sell some fixed assets. Those are all cash activities coming in. We have some other cash activities coming in. We have some cash sales that take place, and we have accounts receivable that we collect. So all of these bubbles right here, these 5, are cash income or sources to the cash bucket. Some elements going out of the cash bucket are purchase of fixed assets, payment of dividends, payment for inventory, payment for expenses. So these 4 items are the primary items that flow out of our cash bucket. So these are the things that if we're going to manage our cash, we have to be aware on top of all of these issues right here, all of these activities right here in our companies. Well, how do accounts receivable affect cash? Well, every time I collect an accounts receivable, I increase my my cash. Now, accounts receivable represent my decision to delay the inflow of cash from my sales to customers who I've extended credit to. That's really what that amounts to. So anytime I have an account receivable, I have allowed a customer, or I have extended credit to that customer. Now, the life cycle of accounts receivable is something we have to pay attention to. We make a credit sale to our customer. The invoice is prepared and sent to the customer. The customer pays the firm. Now, what happens is when that customer receives the invoice, the accounts receivable clock starts running. That customer knows that. You know that. And so from that point on, you've got to manage what's going on there if you're running that business. So what do you look at? You look at days of sales outstanding. That's one of the things you'll look at. And so that kind of tells you what your average collection period is, the days of sales outstanding. And you calculate that with this formula right here. Days of sales outstanding is equal to accounts receivable divided by the annual credit sales divided by 365. So if I look at a fast company with total sales of $1 million, a slow company with total sales of $1 million, and I have 700,000 of credit sales in either case, but my average credit sales per day is 1,918 in both cases. But my accounts receivable outstanding is 48,000 on average and 63,300 on average for the slow company. Well, how do we calculate that? Well, let's go down here. On the fast company, we take the accounts receivable, the average accounts receivable outstanding. We divide that by the credit sales, annual credit sales of 700,000 divided by 365, and we come up with 25 days. Now, the slow company's days of sales outstanding, I take my average accounts receivable, and I divide that by my annual credit sales divided by 365, and it's 33 days. So you can see what's happening here. The fast company has accounts receivable sales outstanding of 25 days. The slow company has sales outstanding of 33 days. That is a real problem here because now my cash, that sales outstanding, is credit that I've extended. And the thing you have to understand at operating your business is that's my cash that is in somebody else's pocket. So for the difference between these companies, for 8 days, my cash is in somebody else's pocket in the case of the slow company. Okay? So now you can see how important it is that we manage our accounts receivable, that we manage our days of sales outstanding. We want to make that as small as possible. So what are some credit management practices you can think about? You can try to minimize the time between shipping, invoicing, and sending notices on billings. So what I would recommend is each time you make a shipment, you send an invoice with that shipment so that that customer gets that invoice, and that customer understands that the credit clock is running when they receive that invoice, and you know that. You can review their previous credit experiences with the customers to determine what kind of problems you may have that, and we'll talk about this more later. But one thing you can do here is you can do an accounts receivable schedule where each week or each month or each period of time, each quarter, you look at all of your accounts receivable and all of your customers, basically, and you look and see what their payment records are, and you go after the ones who are slow pay, get them to pay up. And sometimes you have to tell a customer, look, you're too expensive for me to have as a customer. I'm going to recommend that you either pay cash or you get your stuff from somebody else. So that's called aging your accounts receivable and managing the accounts receivable schedule. So you manage that on a monthly or even a weekly basis to identify delinquent accounts, and then you got to go manage those. Most small business owners, most entrepreneurs, are very reluctant to do this because this is a confrontational activity. So, but let me just remind you, there is nothing absolutely wrong with calling someone who is holding your money and asking them to pay you your money. So you want to use a lot of whatever the most effective methods are for collecting overdue accounts. We can talk about those in a little bit. And you want to always use a lockbox to collect them. In other words, that payment comes into a locked box, a post office box or some other receptacle, and it stays there for you. It's protected. Now, there's something called accounts receivable financing, and this is where you can pledge your accounts receivable for collateral against a loan, or you can factor it. So there's really two ways to finance against your accounts receivable. With your local bank or your company's bank, you pledge your accounts receivable as collateral against a loan or a debt that you're going to take, or you can factor it. There are companies around that are called factors, and they will factor your accounts receivable. And basically what they do is they will lend you money discounted against your accounts receivable, and they will charge you interest on that money until those accounts are collected. Now, the problem with that is, the obvious advantage is you get immediate cash. The disadvantage is it's very costly to do that. You only get a fraction of what your accounts receivable are worth. I'd recommend that small businesses stay away from that if at all possible. Now, managing inventory. Inventory is a necessary evil. You got to have inventory to do whatever it is you do. But what you want to do is you want to manage it very carefully, and you want to keep that inventory time, the days in inventory, as slow as possible. So you determine the age and the suitability of your inventory for sale. Sometimes inventory comes in, it sits on the shelf, it gets too old to resell and becomes worthless, and so that's another loss item you have to deal with. So it's really important that you age and manage what you have sitting in inventory. Slow-moving inventory can create cash flow problems. Remember, for every item of inventory that I have tied up in my warehouse, that's $1 of cash that I don't have available to use in my business. So inventory ties up your cash. Days in inventory is how many days on average something stays in inventory, and you want to keep that number as low as possible. So days in inventory is equal to the total inventory divided by the cost of goods sold divided by 365 days. So days in inventory would be your average inventory over the year divided by the cost of goods sold divided by 365 days. These items, by the way, come off of your balance sheet. Well, let's manage accounts payable now. We talked about that too. Remember, we said accounts receivable and accounts payable, really important that we try to get those managed and under control so that we can reduce our cash conversion period. So we always negotiate with your creditors to, if you need some additional time, let them know ahead of time. And one thing I will tell you, do not wait until it's too late to call your creditor, your supplier that's giving you credit, and ask for additional time to pay. Don't let them call you. You call them ahead of time. They will appreciate that. More than likely, they'll probably give you some additional time. Your creditor's funds, this short-term credit that you get from your suppliers, can supply short-term cash needs for you until payment is demanded. And if you go back to Quick Turn, the example that we had, you'll see that they were stretching their payments out for 60 days. Most creditors or most suppliers would not favor that, but they were doing that. And sometimes in special situations you can do that and get away with it. Particularly if you're a loyal customer, if you're a steady customer, If you're buying large amounts of product from a vendor, they're more prone to cut you some slack on your accounts payable period. Classic example. People who sell to Walmart. Walmart is noted for being slow pay. So I sell to Walmart on credit. They are a loyal customer. They buy from me all the time. They come to me exclusively. They treat me nicely, but they're slow paying. And so what's Walmart doing? They're pushing that account payable period out as far as they possibly can to minimize what? Cash conversion period. So let's remember that. One thing you can do is take advantage of cash discounts. We're going to give you an example of that in just a minute. That can make a big difference in the cash flow into your business. So on the concept of buy now, pay later, you want to pay early enough to get your cash discounts and timely enough to avoid late payment fees. So there's a window in there in which you really need to operate on that. Now let's look at the impact of these small discounts you can get. And sometimes you'll see a term like this. Our terms are 310 net 30. What that means is that if you pay your bill, if you pay the invoice within 10 days, you can take a 3% discount. If you wait longer than 10 days, the net of the bill is due, of the invoice is due within 30 days. So I have a 10-day window in there in which I can take a 3% discount. We say, well, that's not very much. Well, let's see what that does for you. Here's an example. I have a $20,000 invoice that I've got to pay, and it's got a 310 net 30 term on it. If I pay that within 10 days, I can take $600 off. If I pay it in day 11 through 30, I have to pay the full invoice. So let's see what, by taking that little $600 discount, let's see what that does to me on an annualized interest rate basis. So if I go through the calculations here, I discover that I basically am earning 56.4% on that money. In other words, I'm saving myself 56.4%, or I'm earning that much on that investment. That $600 is a little investment I'm giving myself. That is significant, 56.4%. So what's the bottom line? Take advantage of every discount that you can take advantage of. To do that, though, you've got to manage your cash wisely and have cash on hand to be able to do that. Now, capital budgeting is another thing. When we talk about capital budgeting, we're talking about capital items that we want to buy for our company. A capital item could be a piece of equipment, or it could be a building, or it could be anything like that that falls into the capital purchasing rules of the IRS. And typically that's items that cost more than about $1,500. And I don't know what the current IRS rules are, but that's in the ballpark. So a sophisticated desktop computer would fall in a capital item, and that's an item that I can depreciate then over a period of time. And so I want to be careful how I'm investing my money to grow my business. So in the capital budgeting analysis, what we're looking at are our long-term equipment and facilities investments, such as what does it cost to develop new products? I got to replace some old equipment. I got to construct new facilities. I got to expand sales territories. Those are all capital budgeting areas that I have to look at for my company. And what I try to do is I try to answer this question. Do the future benefits from this capital investment exceed the cost of making the investment? And so there's a whole process we can go through to answer that question. So let's look at that just for a little bit. Some capital budgeting techniques. There's about 2 or 3 things that we can look at. We can look at the accounting return on investment, how many dollars in average profits are generated per dollar of average investment. We can look at the payback period, how long to recover the original profit outlay. And we can also look at the discounted cash flows, which means that we take the net present value of the internal rate of return. Let me say it another way. The net present value of all the profits this piece of equipment will generate versus the cost of the equipment on that day, and see how they compare with each other. You would like for the profits to be more than the cost of the equipment. So 3 rules of capital budgeting. You want more cash rather than less cash. This is true all the time. You want cash sooner rather than later. Again, true all the time. And less risk rather than more risk. And so these are kind of the general philosophy of capital budgeting. So let's look at an accounting return on investment example. Here is an item that costs $10,000. capital item. We're going to look at our after-tax profits to see when it's going to be paid back. And so the way I calculate my return on investment is I look at the after-tax profits that this initial investment, this capital item generates over a 4-year period. This is the average after-tax profits, and divide that by the average investment over that period, which is basically 10,000 divided by 2. So when I look at that, my average profits are $21.25. My average investment is $5,000. That's a 42.5% return on investment. That's not a bad deal. That's something I could really go for. On the payback period, I'm just simply looking at how long does it take to pay this item back. So I've got an original investment of $15,000. I have an acceptable payback period of 5 years on that item, and my annual depreciation is $1,500. So now I'm going to calculate my payback period. I want that thing to be paid back within 5 years. So I look at the after-tax profits. In years 1 and 2, it's $1,000. In years 3 through 6, it's $2,000. I look at my after-tax cash flows, and I calculate now my investment recovery. And so if I go through this calculation, you'll see that I will collect a little bit more than what I invested within 5 years, in years 3 through 5. The average payback period here is 4.86 years. You can go through that calculation and confirm that. Discounted cash flows is where I compare the present value of future cash flows with the cost of the initial investment. So, cash received today is more valuable than cash to be received in the future. So I calculate the net present value of those cash flows, and then I look at the cost of the investment outlay, and that then will give me my internal rate of return. How much do I get back in cash flow as opposed to the cost? So the cost of capital definition is the rate of return required to satisfy a firm's debt holders and investors. Cost of capital is a rate of return that I really want to have on my capital. The opportunity cost is the rate of return that could be earned on another investment of similar risk. Okay? So these are two terms you'll see kind of bandied about in the financial community when they're talking about a firm's operation. Now, in small firms, when we start doing capital budgeting, there's a lot of things that we have to look at. We've got to look at our non-financial variables, our personal variables. We've got to look at any liquidity problems that we might have. What is the certainty of our cash flows or the risk of our cash flows? What about our market? Is it established? Do we have a lot of confidence in our market? What is the size and scope of our projects that we want to undertake? And what kind of managerial experience and talent do we have in the firm? So as we begin to think about in our small businesses about capital investments and capital items, all of these factors here kick in. And this is probably one right here that's really most important, the lack of managerial experience in the firm. Okay, this concludes now Chapter 22. We'll move on to Chapter 23 next.